Shocking financial reality. America is full of opportunity, but right now, millions of people are trapped in a financial grind that feels impossible to escape. Imagine credit card balances piling up into thousands, student loans weighing down entire generations, rent and groceries rising faster than paychecks, and families living paycheck to paycheck while retirement savings remain empty. For many, building real wealth seems like a distant dream. At the same time, the financial world is shifting fast. New policies, new apps, and new social movements are reshaping how Americans borrow, save, and invest. Some of these changes open doors, but others hide dangerous traps that quietly destroy your finances. In the past year alone, we've seen headline-grabbing moves from the Federal Reserve, an explosion of buy now, pay later services, and a grassroots wave called the Great Lock-in, where ordinary people commit to radical financial discipline to reclaim their future. In this video, we're going to walk through 3 huge trends that could determine whether you get wealthier or get stuck. First, the recent interest rate cuts and what they actually mean for your mortgage, credit cards, and savings. Second, the rise of buy now, pay later apps, why they're so tempting and how they can wreck your credit. And third, the Great Lock-in Challenge, a surprising movement of people who used strict habits to escape debt and build wealth fast. This isn't theory. We'll break these topics down with real numbers, clear examples, and practical steps you can use today. You'll learn what to do if you have a mortgage, how to avoid BNPL traps, and how to use the discipline of the lock-in to multiply your savings. If you want to change your financial future, stay until the end, because the final section contains an action plan you can start this week. Before we jump in, hit subscribe and turn on notifications so you don't miss weekly videos about wealth building, money transformations, and the practical moves the rich use that anyone can copy. Ready? Let's start with the Fed, and why an interest rate cut could be the most important money event for your wallet this year. Section 1. Interest rate cuts, what they mean for you. When the Federal Reserve cuts interest rates, the headlines often sound technical. Benchmark rate down, market reaction, bond yields adjust. But the real-world impact hits people in 3 places: mortgages, consumer debt, and savings. A rate cut can lower borrowing costs, change the returns on safe accounts, and shift where smart investors put their money. Let's break it down. First, mortgages. Mortgage rates don't move one-to-one with Fed policy, but the Fed's actions influence long-term rates. If rates drop, mortgage rates often follow, meaning buyers can borrow cheaper and homeowners might refinance to lower monthly payments. Imagine shaving a full percentage point off a 30-year mortgage on a $300,000 loan. That could mean savings several $100s a month, money that can be redirected to paying down principal, investing, or building an emergency fund. For potential homebuyers, this can be a once-in-a-market opportunity to lock in a lower cost of ownership. Second, consumer debt. Lower rates can mean cheaper credit card offers and loan products, but banks don't always pass every cut directly to your credit card APR. Still, competition and rate easing can present chances to consolidate high-interest debt into lower-cost loans, saving thousands in interest over time. The key move for individuals is to be proactive, shop for balance transfers, refinance high-interest personal loans, and avoid new variable-rate debt that could spike later. Third, savings and yields. The downside of rate cuts is often felt in savings accounts, CDs, and other conservative instruments. When the Fed lowers rates, banks tend to offer lower yields on savings, which is painful for savers depending on interest income. That means you may need to shift strategy. Instead of relying on account yield, focus on paying down expensive debt, which gives a guaranteed high return equal to the interest saved, or diversify into dividend stocks, high-quality bonds, or other income strategies that fit your risk profile. Finally, market behavior. Lower rates often make stocks more attractive compared to low-yield cash, and they can fuel asset price gains. That creates opportunity for disciplined investors who buy quality stocks or index funds when the market adjusts. But beware the trap of chasing momentum without fundamentals. Real-world takeaway: if you have high-interest debt, prioritize refinancing or consolidation while rates are favorable. If you're a homeowner, explore refinancing options but factor in closing costs to ensure the break-even timing makes sense. And if you're a saver relying on yield, consider reallocating intelligently, not recklessly, towards strategies that preserve capital and seek better returns. Understanding these moves and timing them correctly is what separates people who merely survive from those who begin to build lasting wealth. Next, we'll look at a consumer trend that's exploded over the past few years: buy now, pay later, and why it's both tempting and dangerous. Section 2, Buy Now, Pay Later, BNPL. Tempting convenience, hidden debt. Buy now, pay later. Apps feel like magic the first time you use them. You see an expensive purchase, a new phone, trendy clothes, or furniture, and BNPL lets you split the cost into interest-free installments over weeks or months. It looks like free money. It boosts conversion for online merchants, and it's especially popular with younger shoppers who distrust traditional credit cards. But the convenience hides a powerful downside. BNPL usage exploded because it solves an emotional problem: immediate desire versus limited cash. Instead of waiting and saving, people rationalize, "I can pay a little now." That small sum thinking accumulates fast. Miss a payment, and fees or late penalties apply. Worse, multiple BNPL plans across platforms can coincide and create a tangled web of obligations you can no longer manage. Suddenly, you've got 5 monthly BNPL payments due in the same week, and your paycheck can't cover them all. From a systemic perspective, BNPL often skirts traditional underwriting. Unlike credit card issuers that assess creditworthiness and report to bureaus, some BNPL providers perform looser checks and don't initially report activity, which can create a false sense of security. But as regulations tighten, reporting practices change, and those BNPL balances increasingly appear on credit files. That can damage scores and affect your ability to secure mortgages or loans. There are also behavioral traps. Because BNPL payments are small, shoppers tend to spend more overall. Retailers exploit this with higher average order values and upsells. The mental accounting trick is real. I'll only pay $25 a month for this, but $25 across 10 plans becomes $250 in monthly fixed obligations over time. If you use BNPL, treat it like a loan. Only buy what you can comfortably afford if all obligations were due at once. Track every plan in a single budget line and schedule payments with autopay to avoid fees. If you're already juggling BNPL debt, prioritize paying down the smallest balances first to reduce the number of monthly obligations. A mini debt snowball that simplifies cash flow. Alternative strategies. Build a micro-sinking fund for expected purchases. Use 0% APR credit card offers sparingly and repay aggressively, or simply wait and save. The sense of empowerment from resisting impulse purchases is as valuable as any dollar saved. BNPL can be a useful tool if used intentionally, but left unchecked, it becomes a silent, compounding problem. Now let's look at a different trend, a movement that flips the script by forcing radical discipline: the Great Lock-in. Section 3. The Great Lock-in, radical discipline that builds wealth. The Great Lock-in is a social financial movement that's gaining traction on social platforms and in local communities. Unlike flashy get-rich-quick schemes, this is disciplined, often boring, and deeply effective. Participants commit to strict financial rules for a defined period, often 30, 60, or 90 days, to reset spending habits, bulk up savings, and then maintain momentum long-term. Examples: people commit to no dining out, no discretionary spending, or 50% of every paycheck into savings. Others do reverse budgeting, where they automate savings first and live on the remainder. The secret sauce is accountability, public or private, and repeatable routines that replace impulse with intentionality. Why it works. Behavior change happens when the environment nudges you. Locking in financial constraints removes the everyday decision fatigue that causes overspending. When you automate savings and ban recurring non-essential subscriptions, you create invisible muscle that compounds. For example, someone who normally saves $200 a month but locks in and saves $800 for 90 days now has $2,400, enough for a serious emergency buffer or the start of an investment. Real stories are compelling. A single mom who joined a 90-day lock-in challenge paid off $6,000 in high-interest credit card debt and redirected that monthly payment into a Roth IRA. A young couple automated savings and within 6 months accumulated a down payment for a house. These are practical human wins, not financial theory. Implementation tips: start small and scale. Choose one dominant expense category, dining out, subscriptions, or clothing, and eliminate or deeply reduce it for 30 days. Automate transfers the day pay hits your account. Public commitments, a group, a friend, or social post, dramatically increase completion rates. Track progress daily. Small wins sustain motivation. Sustaining the gains. After the lock-in, don't revert fully. Gradually reintroduce expenses with rules. 10% fund money, 20% savings, 70% baseline living and obligations, or a split that fits your goals. Use the urgency and momentum to set a 12-month plan, debt snowball, emergency fund target, and a monthly investing plan into tax-advantaged accounts. The Great Lock-in's beauty is its simplicity. Transform habits, create runway, and then let compounding do the heavy lift. It doesn't rely on timing the market or risky bets. It relies on behavior, which is often the hardest but most reliable path to wealth. A conclusion, practical action plan and AMP, call to action. So what should you do this week? Here's a step-by-step action plan that combines everything we covered. 1. Check your rates and debts. List every interest rate you pay: mortgages, cards, loans, BNPL. Prioritize refinancing or consolidating anything above 10 or 10% where possible. 2. Audit BNPL. List all BNPL plans, their monthly commitments, and due dates. Consolidate or pay down the smallest balances first to reduce monthly obligations. 3. Start a 30-day micro lock-in. Choose one spending category. Automate a savings transfer equal to what you'd have spent, and track progress daily. 4. Reallocate wisely. If rates drop and you can save on mortgage costs, calculate closing costs and break-even time before you refinance. If savings yields fall, consider reallocating only after building a 3 to 6 month emergency fund. 5. Educate and automate. Set up automatic investing into broad index funds or retirement accounts. Make your money work without decision fatigue. Remember, policy changes and new apps will pop up constantly. The winners are those who control their habits, avoid emotional spending traps, and use opportunities like lower rates to reduce high-cost debt. Wealth is rarely an overnight thing. It's a series of disciplined moves repeated over time. If this video helped you, hit like, subscribe, and drop a comment with one financial action you'll take this week. Share this with a friend who needs a financial reset.